In this video, we're going to discuss the conceptual framework that's used by the Financial Accounting Standards Board to put together generally accepted accounting principles in the United States. So the agencies that were standard setters before the Financial Accounting Standards Board, which were called the Committee on Accounting Procedure and the Accounting Principles Board, both of those agencies, they lacked a conceptual framework. So they didn't have any theoretical framework that they were working from when they issued accounting standards. And so they basically just dealt with problems that came up in the accounting profession on an issue-to-issue basis. So they were criticized of saying, hey, you're just basically fighting fires here, and every time there's some kind of issue in the accounting profession, you come out, you issue a standard. But what's the overall framework? What are the guiding principles for determining U.S. GAAP? And the FASB was the first standard setter in the U.S. to create such a framework. And they did it, they laid the base for this by issuing 7 statements on financial accounting concepts. And these statements on financial accounting concepts, sometimes you'll see them abbreviated SFAC1, SFAC2, and so forth. Okay, and these laid the base for a framework that has since guided the development of generally accepted accounting principles in the United States. So I just want to give you an overview of that framework and because it's something that will come up in financial accounting again and again. So with this conceptual framework, we first have the objective. What is the purpose of financial reporting? Why do we have financial accounting to begin with? So the purpose, the objective, is to provide information that is useful to investors and creditors. And there are also government agencies and so forth that use financial reports, but very commonly you hear investors and creditors as being the main stakeholders. Now, when we say that the information is useful, what do we mean? Well, we mean that it's something that could potentially change a decision maker's mind. So if you're thinking of investing in a company and you find out, oh, there's this significant environmental liability that I didn't know about before, maybe I don't want to invest in this company now. We would say that, okay, that's financial accounting is doing its job. It has provided you with information that was useful to you in making your decision. And so the building blocks under this conceptual framework for our financial reports and the financial reporting process are these elements. Okay, so we call these basic elements, that these are things that you appear in the major financial statements. These are basically the things that we are reporting. When we think about providing information, we say, what information? Well, we're providing information about a company's revenues, about its expenses, about gains and losses that it's had, about comprehensive income. And if right now you're thinking, I don't even know what comprehensive income is, don't worry, we're going to discuss all of these elements in detail in future videos. Also, we have, for example, the elements of the balance sheet, the assets, the liabilities of the firm, equity, and these I should mention, these are measured as of a point in time. Whereas revenues, expenses, gains, losses, they're for a period in time, like over a course of a year, what was the revenue for the company and so forth. And that might be a little over your head right now. Don't worry, we will get to that in a future video. And then we also have investments by the owners. So if you are the owner of the company and you put up capital, that's one of the elements. And then distribution to the owners, that's dividends, right? So when the company distributes money back to its owners, that's dividends. So these are you can think of these as the building blocks of the financial statements and of financial reporting, okay? This is the kind of information that we're trying to measure with financial accounting. Now, financial accounting, to be useful, to be good, to be something that's of note, we want it to have certain qualitative characteristics. And we can actually break it out into 2 groups. We've got fundamental qualities, and then we've got enhancing qualities. So I'm going to talk about these fundamental qualities first. So we want the financial information to be relevant. If I'm going to great length to create some kind of information that I think will be great for a financial report, but investors, creditors, anybody who uses the financial statements would not care about this information, then we say that it's not relevant. Okay, but if it is something that an investor would hear about and say, hey, I didn't know that before, I don't know if I want to invest in this company, then we say, okay, this is good information because it's relevant. It would affect somebody's decision. And there are different subcomponents of relevance. We can think of information as having predictive and confirmatory value. And so when we say predictive and confirmatory value, what we mean is this. somebody takes information from the financial statements, right? So let's say the income statement, and they're looking at net income and earnings per share, and they're trying to predict future earnings per share. Okay, so we can use financial information to make predictions, and then we can confirm whether those predictions actually come true or not, right? That's a lot of what is being done with financial accounting, is investors and creditors are looking at the information in the financial reports and trying to make an educated guess about what will happen in the future. Now, when we think about whether information is relevant, we also have a consideration called materiality. And materiality is basically saying that some things are so small and trivial that it wouldn't really matter to an investor. So let's say we were trying to count the inventory for Walmart, and I found out that, you know what, we were actually off by $8 when we counted the inventory for Walmart. Well, Walmart is such a huge company, and their inventory is billions and billions of dollars. Being off by a small amount, we would say that's not material. It's trivial. However, if information is material, then it needs to be in the financial statements, right? We'd say that it's relevant, okay? Now, there are some constraints that we're going to talk about. We're going to talk about a cost constraint. We'll get to that in a moment. We can't include everything in the financial statements, but we'll get to that in a bit. Now, information not only is good information relevant, but it's also a faithful representation of what actually happened with the company. And sometimes you'll hear faithful representation. Sometimes people will say reliable, right? So information needs to be relevant, but it also needs to be reliable. So it's relevant if I tell you that, okay, the fair value of this building is $10 million. That's relevant to you to know the fair market value of that building. However, is that a faithful representation? Is the building actually worth $10 million? It may be relevant, but if it's not a faithful representation, the information I give you, if there's an error in it, it's a mistake, or if it's not complete information, I'm leaving something out that's really important, or if it's not neutral, I'm biased and say, yeah, it's worth $10 million, but it's really worth $2 million. If we've got any of those issues, then we could say that the information, even though it might be relevant, is not a faithful representation of the firm's actual financial information. And there's a trade-off sometimes. We think about, we want information that's relevant, but sometimes information that's more relevant, like a fair value, is more difficult to say that, okay, this is the actual faithful representation of what the value actually is. Okay. Now, those are the fundamental qualities of financial accounting information, but we also have enhancing qualities, and these are very important as well. We want information to be timely. If we say, yeah, I can come up with a really good estimate of this firm's net income and for this current year, and I'll have that report to you in 5 years. It's like, hey, that's not timely. The investors and creditors want to make a decision today. And they're not interested in waiting 4 or 5 years to find out whether the company made a profit this year. So information needs to be timely, but also needs to be verifiable. If I tell you, okay, I've got some auditors, and I say, hey, auditors, go and count how many machines this company has. They say they bought 5 machines this year. Go verify that. Well, one of the auditors comes back and says, yeah, there's 5 machines. Another one says there's only 2 machines. So we need to be able to go for the information to be useful, to have any kind of value. It should be verifiable. We should be able to have 2 people go back and come back with the same count. And the information needs to be understandable. We can't, if firm just gives you a disclosure that is so complex that no one could possibly understand it, then what value does that have to investors or creditors? And then also, ideally, information should be comparable. And so when we talk about comparability, we're talking about is let's say we've got firm A and we've got firm B, and they both have inventory. We'd like to be able to look at their financial statements and say, okay, these were presented, or these were created according to GAAP, and so we could say we can compare firm A and firm B, and we can think that their inventory was counted under the same rules. Now, there are different methods for, we talk about FIFO and stuff like that, and we'll talk about that later, but generally speaking, we want to be able to compare 2 sets of firms. So for investors they're not just thinking about one company, they might be thinking about 3, 4, whatever companies, and they want to compare them. So if the financial statements are presented according to GAAP in each case, then we're good. And this is actually a major argument for going more towards international financial reporting standards. And we talked about in our video with the IASB, and they're trying to create one set of global accounting standards and that all companies would ideally follow. And then we'd say, oh, if firms even across countries now, their financial statements are comparable. So that's an important quality of financial accounting information. Now, in addition to all those qualities we talked about, in addition to the elements we talked about, we also have certain assumptions and then guiding principles and constraints that we're going to discuss. So one assumption is that we assume that when we're doing the financial statements, we're doing it for a specific economic entity, which is separate from other entities. So when we look at the financial statements for Walmart, that's separate from Walmart's owners and stakeholders. We're just looking at Walmart as a single entity and then saying what's its income statement look like and so forth. And then we're going to make some assumptions. We're going to assume that the firm is going to continue indefinitely. When we're looking at the firm and we're depreciating assets or so forth, we consider this firm is going to go into the future. We make that assumption. Maybe it won't. Maybe it turns out the firm goes bankrupt next year. But we generally assume that the company is going to go into the future. And so consistent with that, we're going to break information into periods, and we call this periodicity. We say we're not going to wait until the firm wraps up operations 1 year, 10 year, 50 years from now to say whether it made a profit or loss. We're going to go and say, what was it for this quarter? What was it for this year? So firms issue a 10Q to the Securities and Exchange Commission for their quarterly results, a 10K for their annual report. So we break accounting information into different periods. And then the financial information that's in those reports is based on monetary unit, which in the U.S. would be dollars. We're saying, how do we measure the value of this machine? Well, we don't value it in coconuts or bananas. We value it in a monetary unit, which in the U.S. again is dollars. Now, the principles that are behind U.S. GAAP is, one is that we have mixed attribute measurement. What that means when we say mixed attribute measurement is we have different ways that we measure assets. We don't measure all assets the same way. So typically, like for example, when you buy a building, we measure that at historical cost. We look at the purchase price of the building. Now you would go and then depreciate the building and present the net amount minus the accumulated depreciation and so forth, and we'll talk about that later. But the purchase price of the building, the historical cost, would be the initial value on the balance sheet. But then for other things, like for example financial instruments, we would value them at fair market value. So we say mixed attribute because we have different ways of valuing different things. We value inventory differently than we do investments, differently than we do a purchase of a building, and so forth. So that's what I mean by the mixed attributes. Revenue recognition, we have a standard that was issued on revenue recognition, and I've got a video on that. But the basics are this. A firm recognizes revenue, for example, from a sale in the period in which it performs the service that it was supposed to do or delivers the good or that it was supposed to deliver, right? So if let's say Walmart, they sell something to you, they recognize revenue when they've actually delivered that good or service. So even if you haven't necessarily paid them cash in that same period, right? It's not just when they get the cash that they recognize the revenue. It's when they've actually delivered the good to you or performed the service and so forth, right? Now, we also, with expense recognition, which we sometimes call the matching principle, we try to match expenses and recognize expenses in the same period in which they were used to generate revenue, right? We don't always do a great job of that, but that's the general idea. And then we try to fully disclose all information that would be relevant to decision makers. However, we have some constraints, and one of the biggest ones is cost. So it is not free to produce financial information and financial reports. It's not free. It's costly. And a lot of people complain, for example, with Sarbanes-Oxley Act, that Section 404 made firms issue report on the effectiveness of their internal controls, and they say it's very costly for us to go and do this assessment. So firms typically will complain and say, hey, there's significant costs here in producing this financial information. So do the benefits of this financial information, of producing it, do they justify the cost? And that's an issue. Companies will always say, the cost exceeds the benefit. And then the regulator, the FASB, will say, no, the benefit to investors and creditors, it typically exceeds the cost. So, but we can't just have a firm disclose absolutely everything because there's a cost to it. Okay. Now, also, there's industry practices that limit what is disclosed as well. So, for example, with the banking industry is actually highly regulated beyond just FASB and U.S. GAAP. They have they're regulated by the U.S. government because you're worried about like a banking panic and stuff. So we make sure that they have a certain amount of capital that banks have on hand to satisfy depositors. They don't have to have all depositors' funds available on hand, but they do have to meet these capital adequacy ratios. So we call it the RAP, regulatory accounting principles, right? So and I'll make another video on that, but just suffice to say that the insurance industry, banking industry, sometimes they'll have specific practices that kind of change what their accounting should be relative to regular, just plain vanilla U.S. GAAP. And then also another constraint is conservatism. And conservatism has been often, people say, anticipate all losses but not all gains. So you'll have where you're more quick to recognize a loss than you are a gain. So, for example, when we think about a contingent liability, so a contingent liability, when it's probable and reasonably estimable, we recognize that contingent liability. However, contingent gain, we would not recognize, and even if it met the same kind of threshold of being probable and reasonably estimable, because we're recognizing a potential loss, but we're going to hold off and be conservative and not recognize a gain until it actually occurs in that particular instance. So that's the idea behind conservatism.